Most people, they pick a mortgage term based on the rate, and that's the wrong starting point. And I've seen it cost people tens of thousands of dollars that they never saw coming. Not because they made a bad decision, but because nobody showed them the full picture before they signed that mortgage commitment. So by the end of this video today, that changes. Let's go. I want to start with a number that stopped one of my clients cold when I told them. 3 out of 5 mortgages in Canada never make it to the end of the term. That means if you're in a room, 3 out of your 5 friends pay a penalty. That's not a guess. That's the reality of how Canadians actually live inside their mortgages. Most people are going to break their mortgage early, whether they plan to or not. It's inevitable. We have job change. We have promotions in different cities, a new baby needing an extra bedroom. Unfortunately, there's divorce or death in a family, or a business opportunity that requires pulling out equity. Life, it doesn't wait for your 5-year fixed term to expire. And if you're sitting in the wrong product, when that moment hits, guess what? You're paying a massive penalty, not a small one. And that penalty is the thing that your bank is not going to volunteer or explain when you're sitting across the desk from them picking a low rate mortgage. So that's what we're going to cover today. We're going to talk about magnitude of things. So how penalties actually work, why fixed rate mortgages carry more risks than most people ever realize, what's the difference between a bank penalty and a monoline penalty, how to think about the fixed versus variable question in a way that actually serves you, and then what structure looks like when you nail that and get things right. So by the end of this video, you're going to have a completely different outlook for how to evaluate your mortgage options. Not basing it on rate, basing it on the full picture, like what I call a 30,000 foot view. So let's start with penalties, because this is where I see the most damage done daily. When you break a fixed rate mortgage early in the term, and again, 3 out of 5 of you do, the lender calculates what's called an interest rate differential penalty, an IRD is what you'll hear it referred to as. And here's how it works in plain English. The lender's going to look at the rate they gave you. Then they look at what they could lend their money out for today. Then the difference between those two numbers multiplied across the remaining term and months of your mortgage and your outstanding balance. That's your penalty. So when rates drop after you lock in, that gap gets wide, and today wide means expensive. I've seen penalties 10, 15, 20, north of $40,000. That money's gone. But here's what makes it even worse if you're dealing with a big bank. The major banks in Canada, they have this Fugazi, this proprietary IRD calculation that almost always doubles, triples, quadruples the penalty compared to what you'd pay at a monoline lender. Like, we're talking seriously 3 to 5 times higher in some cases. So the client who locked in at the big bank, like a big blue one, because they felt comfortable or because they offered a low rate, they're the ones getting hosed, and they get the worst of it when life changes. Monoline lenders, on the other hand, they're lenders that specialize purely in mortgages. Companies like First Nat, MCAP, CMLS, Strive, their penalty calculations are typically more straightforward, more transparent, and significantly cheaper. That's not a coincidence, my friends. That's the business model. Your bank is a full-service financial institution. The mortgage is only one product on a shelf. They're not optimizing for your flexibility. They're optimizing it for their profit margin with their shareholders. A monoline lender, they live and die by the mortgage volume that they fund. Their products tend to be cleaner. I'm not saying big banks are evil. I'm just saying you need to understand what you're buying when you sign that mortgage commitment. Now, let's talk about the fixed versus variable question, because this is where most of the confusion lives, and it's a conversation I have daily. Every time rates move up or down, my phone rings. Should I lock in? Should I go variable? What economists, what are they saying right now? And I get it. I mean, I understand. It feels like the right question to ask. It's the question that mainstream media is absolutely obsessed with. But I'm going to tell you something that might be a little bit uncomfortable for you to hear. Trying to time the rate market, it's a fool's errand. I've been doing this for 6 years. I talk to clients every single day. I read all of the economic commentary, and I can't tell you, or actually I can tell you, nobody consistently knows where rates are going. Not economists, not bankers, not even me. So if you're making your mortgage decision based on your prediction of where rates are heading in 24 to 30 months, you're gambling. And that's not a strategy, that's just a coin flip with basically a 25-year debt attached to it. The real question, the one that actually determines whether fixed or variable is right for you, has nothing to do with rate forecasts. It's this: what is your life going to look like in the next 3 to 5 years, and how much flexibility do you actually need? Because here's the thing about variable rate mortgages that nobody talks about enough. Sure, some of them, the payments fluctuate with prime rate, and yeah, that can create uncertainty in your monthly budget, but the penalty to break a variable rate mortgage is almost always just 3 months simple interest. That's it. 3 months of interest on the balance of your mortgage at your current rate. Super simple. For most clients, that's somewhere between $3,000, maybe $6,000 versus potentially $30,000, $40,000, $50,000 on a 5-year fixed at a big bank. So when you frame it in that way and you take a step back and look at it, when you actually put the exit costs side by side, variable rate mortgages, they start to look a lot less risky. The rate uncertainty is totally visible. You feel it every time your payment changes, but the penalty risk on a fixed rate is invincible right up until the moment it knocks you over. And I've had more clients devastated by penalties than I've had by rate increases. Think about that for a second. Now, I want to walk you through some of the specific life scenarios where fixed rate mortgages tend to trap people, because I think it just makes sense and we should chat about it. The first one, if you're planning to move. Let's say you lock in for a 5-year term today. 2 years in, you get a great opportunity, a bigger house, different city, job relocation. Your bank says, don't worry, your mortgage is portable. And yeah, sure, most fixed rate mortgages, they have portability provisions. But here is what portability actually means in real life. So when you go to port, you typically have to keep the same amortization schedule. So if you're moving to, let's say, a more expensive property and need to blend and increase the amount of money you have owing on your mortgage, things will get complicated fast. And there's a timeline issue as well. Most lenders will give you 30 to 90 days to complete the port. If you miss that window, you're going to be paying the penalty regardless of what happens. And I'm seeing this right now with clients who sold their home, thought they could just port it, and discovered after the fact that they didn't qualify on the new property under the current stress test because their income situation, it changed like marginally, and now they're paying a penalty and they're getting a brand new mortgage completely. That's fucking brutal. That's a brutal combination. The second scenario, you want to pull some equity out. Maybe your house has appreciated over the last couple of years and you have some equity and you want to do a renovation. You want to finish the basement and add a suite or build a man cave garage, whatever it is. If you're in a 5-year fixed and you want to refinance to access that equity, you're looking at a massive penalty. Or maybe you want to use that home equity line of credit alongside your mortgage, depending on your lender and your product. That may not be possible to add midterm without breaking the mortgage. So let me re-say that again. If you wanted to add a HELOC to your mortgage, it might not be possible midterm with some lenders. So the equity you've built, the opportunity right in front of you, it's gone. It's locked out. You never had it. The third scenario, your income or your life situation changes, and this one's big and it's personal. It hits home with most people. Let's say you have a cosigner on your mortgage, a parent who helped you qualify. At some point, you want to remove them from the title. That's called a refinance. So if you're in a 5-year fix at a big bank, you're going to be paying to remove that cosigner. Or let's say you're self-employed and your income structure changes. You want to restructure how you're going to be qualifying. Again, you may need to break and reset and pay a penalty. The point isn't that fixed rate mortgages are bad. I'm just trying to show some clarity that they carry a hidden cost that most people never factor in when they're staring at that rate comparison sheet and taking Big Blue's 3.45 5-year fixed offer. The rate, it's just the advertised price. The penalty, that's the fine print that no bank is ever going to explain to you. Now I want to talk about what I actually do with my clients, because this is where the conversation shifts from fear to strategy. When a client comes to me, whether it's a purchase or a refinance or a renewal, I don't start with rate. I never do. I start with structure. I ask meaningful questions like, what does your life look like in the next 2 to 3 years, in 5 years, in 10 years? Are you expecting your income to grow? Are you planning for a family? I had my family grow in the last 5 years. Are you? Is there a business purchase on the horizon? Do you have any debt that you want to clean up? Do you have that truck loan, the Tesla loan? Because the answers to those questions are going to determine the right product for you, not the rate sheet. Sometimes the right answer is a shorter fixed term, 2 or 3 years, to give you rate certainty while preserving flexibility sooner. And sometimes the right answer is variable with a solid prepayment strategy, so you're using the payment flexibility to pay down principal aggressively. Sometimes it's a hybrid structure. Let's split the mortgage between fixed and variable to hedge our bets. And sometimes a 5-year fix, it makes total sense. If you truly know that you're not going to be moving, you're not going to be refinancing, you're not changing anything for 5 years, and you're the kind of person who will lose sleep over payment uncertainty, then lock it in and sleep like a fucking baby. But make that decision with eyes wide open. Know your penalty calculation, know what it actually looks like, and know your prepayment privileges. You need to know what the portability terms are if you decide to actually move. Have those in writing before you sign anything. That's the job. Here's the other thing I want to address, because I hear this every single day. My bank gave me a great rate, so I went with them. I understand why that would feel like a win to you, but rate is one number on a spreadsheet. The total cost of your mortgage over the 25 to 30 years, that's not one number. It's the rate plus the penalty exposure plus the prepayment flexibility you may or may not use, plus the compounding effect of whether you're actually paying down principal efficiently or aggressively, or if you're just servicing the interest cost of the mortgage. I've shown clients the math where a slightly higher rate at a monoline lender with better prepayment privileges and a lower penalty if they ever break, the structure of that actually cost them less over a 5-year term than the lower rate at their bank. The bank won on one number with you. They lost on the 30,000 foot view. That's the structure conversation. That's what I do. And the client who goes through this process, who actually maps out their mortgage against their life plan, they don't end up surprised 3 years in. They know exactly where they're going to be and what it looks like and what their options will be if anything changes in their life. That's the difference between having a mortgage and having a mortgage strategy. If you want to know what your structure could look like, what the right product should be for your specific situation right now, comment playbook below and I'll reach out personally to book a call and we'll walk through it together. There's no pitch, no pressure, just the full picture laid out clearly so you can make the right call for you and your family. And when you're done with this one, please go check out my last week's video where I break down everything that you need to know as a first-time home buyer in 2026. I'll see you there.